this is actually very, very, very important. Markets peak in a secular way most of the time when the Fed is raising interest rates, not when they're lowering rates. And if we're truly in an easing cycle where rates are going down, this is not a topping market. This is a market that's stimulating risk assets to go higher.
The government is shut down, the trade war between the United States and China is heating up again, and what felt like one of the most bullish market setups in a long time has suddenly become highly uncertain again. Hello and welcome to Milk Road Macro, the podcast that regrets to inform you that Uptober has been canceled and replaced by Trumptober. I'm your host, John Gill, and today is Monday, October 13th, and we are joined by Mary Ann Bartels. Mary Ann is the Chief Investment Strategist at Sanctuary Wealth. Mary Ann has decades of experience on Wall Street. She previously held key roles at Bank of America's Merrill Lynch, including head of the Research Investment Committee and ETF strategy. Mary Ann is going to help us make sense of everything that's going on in the markets today. So if that sounds good to you, make sure you like and subscribe. Share this episode with someone who needs to hear it. And as our reminder, our Milk Road Macro team lives and breathes this stuff. Every month we drop a pro report breaking down what's going on in the markets. Just about a week ago, we put out a report on running it hot. What does that mean? What do you need to know? There's over 50 charts breaking down everything. So if you want to get in on that alpha, join our pro community today. Link is below in the show notes. And without further ado, welcome to Milk Road Macro. Mary Ann, how are you?
Good. How are you?
I am great. I'm excited to get your thoughts today. So I wanted to start with the trade war. Everyone has been talking about this. On Friday, Donald Trump sent out a Truth Social post that reignited the trade war and threatened a 100% increase on tariffs on China. China has been clamping down on rare earth exports. But then on Sunday, Trump posted again saying, don't worry about China. It will all be fine. What's your take on this situation? Are you worried about the trade war heating up again? What are your thoughts on this situation here?
So I'm going to just take a look at the market. And if you were looking at the market technically, it was extremely overbought. We were getting conditions that are known as negative divergences. What's a negative divergence? When a market keeps going up and the price momentum is rolling over. So it would have been any piece of news that could potentially take the market down into a correction. It just happened to be Trump tweeting. We've been looking for a 5 to 10% pullback just to refresh this market. And I think we're in that. The one thing that October is traditionally known for is for bad events within the market. But what they don't say, which is what I really think is the truth, is October sets up a great buying opportunity for the seasonal year-end rally that we traditionally have going into November and December. So I'm really not sweating this new trade war, but volatility spikes for the first time since Liberation Day. So I can see where some people or basically some investors maybe get a little bit unnerved from it. But I just think this is normal volatility and a normal pullback.
How are you writing out this volatility? You know, you said you were expecting a pullback. Are you taking some risk off and waiting for this to blow over? Are you adding to positions, or are you just holding through this?
So in September, one of the models that I manage, I already started to reduce volatility, looking for volatility in September. And as you know, we didn't get the volatility in September. But because of those negative divergences that were in place, I was just comfortable just taking a little bit off the table. And now I'm going to be looking for opportunities to add back. But for investors that are investing for the long term, we never suggest taking tactical positions, because what we find, it's very easy to sell, but it's not very easy to buy. Traditionally, when a professional should be buying, it's during very bad news. And the individual investor has a very hard time buying when there's bad news. But if you look at every major low in the markets, we can historically see that it was a great buying opportunity. But if you looked at the headlines, it certainly did not seem like a good buying opportunity.
Presidents Trump and Xi have a face-to-face meeting that's scheduled for the end of this month at the Asian Pacific Economic Cooperation Summit. I think I have that name right, the APEC Summit. There's been talk about this meeting being canceled, but so far it's still on. Are you watching this meeting closely in terms of outcomes from it for indicators of market movement going forward? What are you thinking is going to be the outcome of this? Do you think we're going to get a deal, or is this trade war going to keep going on and on? Like, what are you expecting here?
Well, the thing is that we're never going to know what the actual outcome is. And markets go up based on earnings. And we're entering the third quarter for earnings. So what I'm really going to be paying attention to are what are companies saying about their current business environment, and what are they seeing as they're going into the fourth quarter and possibly even into next year.
Gotcha. Okay, so you're paying attention to what the market's saying as opposed to trying to guess what the future might bring. Is that kind of what you're saying there?
Exactly, because if we really were investing based on a trade war, we would have never bought the market back in April. And it was hard to buy the market back in April because Liberation Day and the tariffs, to the extent that they were shown in the beginning, was something that I've never even seen in my career. And that's a 40-year career. So how do you price that? But we've learned that there's a lot of negotiation techniques that President Trump uses. And so I think there's a lot of additional tactics that he can use to try to get the trade deals that he wants. At the end of the day, I do believe that President Trump wants a strong economy. He wants strong U.S. companies. And what you get in result is a strong stock market.
Yeah, and I think that President Xi wants the same thing. So hopefully they'll come to a deal on that. You brought up Liberation Day in April, and I was really curious to hear your thoughts on this. Do you think that there are lessons from how responded in April to the Liberation Day tariffs that could be applied to this situation here, or do you think that we're in a totally different market and we're going to get totally different behavior? How similar is this to what happened in April versus how new is this paradigm that we're in?
Oh, this is not even a comparison to what happened to us in April. If the tariffs that were announced back in April were actually implemented, we'd be in a recession right now. And so very, very different. So what's happening between us and China, I think, is a little bit more tactical and not a major strategic long-term impact.
Gotcha. Okay. I want to pivot now to another thing that's on a lot of people's minds, which is the federal government shutdown. You wrote a recent report for Sanctuary about this shutdown. You noted that historically government shutdowns do not have an outsized impact on the market. Is that what you're forecasting for this shutdown, or do you think that there's something different about this time? What's your thoughts on this shutdown?
So yes, traditionally we went all the way back, and markets generally have a zero return during a government shutdown. But we did specifically hone in on the last time President Trump was president during his first term. We did have a government shutdown for 34 days, and the market went up 10%. So here, I don't think we're going to have any type of negative impact. In fact, you could possibly even have a positive impact.
That's interesting. Okay. I'm curious to know your thoughts on the length of this shutdown. Obviously, you referenced the 34-day shutdown, which I believe is the longest on record. Prediction markets right now are estimating that this shutdown will last 21 days or more. I believe that obviously is a little bit in flux, but do the risks of market harm or damage to the economy increase the longer this shutdown goes on, or does it not really matter? Like, what are your thoughts on that?
It feels terrible when you look, and you were correct, 34 days was the longest in history, and we survived that totally fine. Those workers that are not getting paid do get paid eventually. All the bills eventually get paid. We've never had a time in history where the government stayed shut down. So I'm going to make a good positive assumption that we're not going to close the government forever, and that we'll eventually get this government open. And I'm really not expecting any type of negative material impact. It may be a little tough for those that are not getting paid, but eventually, if it doesn't last forever, they'll eventually get paid and they'll eventually be able to pay their bills. So I'm not that concerned about the government shutdown.
Gotcha. Okay. I want to ask one more question about this because I think that this time there are a couple things that are a little bit different here. One of them is that the Trump administration seems to be using this as an opportunity to lay off a lot more federal employees. And I think that this is partially like some kind of version of his Department of Government Efficiency effort, trying to reduce the size of government. Are you concerned about this at all? Does reducing the federal workforce by thousands and thousands of people, does that impact your outlook, or do you think that this will all come out in the wash? Like, it's just not bothering you?
Well, I can honestly say this is not traditional. It's not something that we historically see, but it's not something that I think is going to have a material impact on the economy, at least not at this time. The government has been a very good employer and has hired many, many people. There are some firms on Wall Street that annually believe that you should be laying off people, those that are not efficient workers. So if you look at it from a business perspective, there are businesses that try to make sure that they always are running efficiently and don't have any excess employees or don't have workers that are not highly productive. And since President Trump seems to be the type of president that likes to run the government like a business, that's kind of how I would look at it.
Gotcha. I think that makes sense. Okay, we can shift a little bit from this topic because it's political and it's heated, but it's helpful to know that you're not scared for the market, at least right now. I think something I want to ask you about that is also impacted by this shutdown. You've been calling for continued rate cuts from the Federal Reserve, but the shutdown has stopped the Bureau of Labor Statistics from publishing new labor data. What are your thoughts on that? How important is it to get this updated labor data? Is the Fed flying blind into their October meeting? Like, what are your thoughts on that situation?
Well, there has been an announcement that they are trying to bring back workers so they can get the CPI data out. And if they get the CPI data out, that would certainly help support the Fed in whatever decision they make. So, and if they don't have that data, it becomes a little bit more challenging to be able to support the cut. The market is still expecting a rate cut at this Fed meeting of 25 basis points, and they're also expecting another Fed cut in December. So what happens if we don't get the data and the Fed decides to pause is you can get more volatility in the market because the market has to reprice itself. But I don't think it has a significant repricing. We've been through this before a couple of years ago where we thought we would get rate cuts and we didn't get rate cuts and the market's just repriced. And here we are, we're sitting near record all-time highs. So I just think it's a temporary kind of event that's not going to have a sustainable impact.
Gotcha. Okay. So you think that whatever does happen this month, the broader trajectory for the Fed remains the same, and eventually they're going to be lowering rates. Does that? Oh, sorry. Go ahead.
I was going to say the market is expecting them to lower rates. Doesn't mean that I agree with that. So that's a different issue. So we can talk about that if you want. But I think the market is anticipating rate cuts, and I can tell you if you technically look at the 2-year Treasury yield, which is a very good predictor of the trend in rates, it is predicting that rates are going lower.
Okay. Yeah. So this is another thing that I did want to ask you about. In the reports you've been writing for Sanctuary, you've been very tightly scrutinizing the minutes from the Fed meetings and trying to read the tea leaves, so to speak. Do you agree with the market that these rate cuts being priced in is the right forecast, or do you see something different happening here?
So when I went to college, which was a while ago, and I took my economic classes, if a professor gave us an exam question saying that the economy was growing at 3.8%, that corporate profits were growing double digits, that employment rate was basically at full employment, even though the rate is going up, a 4% handle means you have a very strong economy. If I had written as my answer, the Fed would be cutting rates, I would get that wrong. So, it's not the type of economy that traditionally we see lower interest rates. Now, I understand why President Trump would like to have lower rates, because part of the economy that's really not working right now, or that's not fluidly working, is the housing market. And for our economy, interest rates on a mortgage up around the 6%, 7% handle is not moving the market because so many homeowners have interest rates that are down into the 4 or 3% type of rate. So if you want to get housing kind of moving, you do have to have lower rates. But to have a stronger economy, I don't think you need to. The other thing is when I went to college, our economy was driven by manufacturing. And today our economy is driven by services. Manufacturing is very interest rate sensitive. Services is not as interest rate services. The consumer is 70% of GDP. If the consumer is willing to spend, our economy is going to grow. And higher or lower rates may or may not have an impact in their spending habits. So, and when we look at the consumer today, it is a bifurcated consumer. The high end continues to spend double the rate of the low end consumer. But when we look at the savings rate, it's higher, disposable income is rising. So if you just took the consumer in aggregate and they're basically employed, because a 4% handle is basically saying you're at full employment. Your economy is going to grow. You're going to really have to get unemployment up around 5% or more, probably before you have a problem with the consumer. So net, interest rates are going to go down because that's the direction it seems that the president would like. The Fed says they are concerned about employment. They don't want the employment rate to go up significantly higher, so they're willing to support the employment side. But I would say if you were looking at the inflation side of the equation, because the Fed is looking for a 2% handle, we're running more closer to a 3% handle. That side of the equation would basically say, don't raise rates.
Gotcha. Yeah. And I think that this is sort of what Powell has been alluding to in his recent comments, saying that there's no risk-free path for the Fed. So I think we're all going to have to continue to be very close Fed watchers here. So appreciate your thoughts on that. That's very helpful. One thing that you touched on, I want to get your thoughts on that I hadn't really planned to ask about this, but it's relevant. So Secretary Bessent has talked about possibly declaring a national housing emergency, specifically to deal with some of the issues you raised. What would that look like? What would you expect to come out of a policy path like that? And what does that mean exactly? Like for the Trump administration, for the markets, like what would be the impact of that?
I have no idea because we don't have any information. And I don't think we have a housing crisis. What it does tell me is that the president's concerned about housing and wants to help Americans be able to purchase housing. But that's a whole other different topic where, young adults that want to buy their first home, if they have a lot of student debt and their salaries are not at a level that can handle a mortgage rate, that's a whole other type of equation. But I do see a lot of younger people not able to afford a house, and they can't afford the down payment to the house. And when people have asked me, well, are you concerned about the housing market? I generally answer no. And the reason why is the baby boomers have a tremendous amount of wealth. And that wealth continues to grow as the market goes up. And I do believe that mom or dad or grandma and grandpa will be able to help their family members to actually buy houses. So that's kind of been my rule that I've been talking about for years, is they'll get family support to be able to purchase that house. And, I'm one of them, trying to help my kids buy a house. And, I talk to a lot of people that are helping their children to be able to get a house. And it makes sense because if you look at rents, and then even with mortgage rates where they are, if you look at the mortgage payment, there's different types of mortgages, but you can get mortgages where they're lower than the actual rents. And then this way, at least you're investing in an asset.
Gotcha. Yeah, I appreciate that insight on that. I think a lot of this is going to be wait and see. For anyone in our audience who missed our episode with Melody Wright, we went in depth on the housing market and got a lot of great insights on that. So if you missed that episode, go check that out. Mary Ann, I want to pivot now to get some of your thoughts on the market outlook. We've talked about a lot of things that are causing some concerns in the market, but you have been very bullish all year, even when others have been fearful. You've called for the S&P 500 at 7,000, Bitcoin at 150K by year end. Does any of these changes we've seen in market dynamics recently change anything about that picture for you, or are you still bullish on Q4 here generally for the market?
No, I'm still bullish, and I'm bullish out to the end of the decade. So one of the things that I've learned how to do throughout the years is to look at different cycles within the marketplace. I think the markets have gotten too short-term oriented. We want that instant gratification, and we want to know what markets are going to do, over the next couple of weeks or a couple of months. But markets actually have three cycles. They have a long-term cycle, they have an intermediate cycle, and they have a short-term cycle. The short-term cycle, I do believe, is bullish, even though we're getting a pullback here. But when I take a look at the long-term secular trend of the market, we went into a secular bull market in 2013. What's a secular bull market? When you take out the previous high. And if you recall, we had a peak in 2000, and we touched that peak in 2007, right? Then we went into the great financial crisis. That whole trading period up until 2013 was called a secular bear market, where a market trades sideways and can't go on to all-time new highs. Also, during a secular bear market, you're down. Your big corrections tend to be bigger. They can be up to 50%, where an average bear market is about 20 or 30%. So we cleared that 2007 all-time high in 2013. And secular trends can last 15 to 20 years. So we're in the later stages of a secular bull market, and I think that secular bull market's going to end at the end of the decade. I'm basically calling for a bubble. If you watched 60 Minutes recently with Andrew Ross Sorkin, he wrote a book about the crash of 1929 and some of the history of the market. And he even said that there's going to be a crash. He can't predict it, when it's going to happen. Well, I'm trying to predict when it happens, and I'm trying to predict that it's going to happen at the end of the decade. And what's going to cause this bubble? A lot of people are saying we're already in a bubble for artificial intelligence or AI. I think we're in the early stages of that bubble. And I can see the S&P almost doubling here in some cases it will double if my projection at the high end hits. I think we can hit 10,000 to 13,000. And I've had that forecast for a number of years. This is not something new that I'm predicting. So I think tech and tech related, because our market is very bifurcated where tech hides out. You have Google and Meta hanging out in communication services. You have Tesla and Amazon hanging out in discretionary. And these are all part of the whole AI trade along with tech. And so I do think that the leadership and the ones to really watch are the semiconductors. And that's not a new trade for me either. Semiconductors are the brains of all of our technology, whether you want to talk about the build out of AI, whether you want to talk about driverless cars, but we already have chips in our cars because they already do beep beeps for us. If you look at robotics, we're building robotics, we're building drones, anything that's, military, we're building, we have to continue to build out military to replace all the military equipment we've been using. A lot of that uses chips, whether it's your iPhone, your iPad, your laptop, if you have an updated refrigerator, oven, dishwasher, washer, dryers, they all have chips. Everything has a chip, different kinds of chips depending on the technology that you're using. And the demand is insatiable, that this is going to go on for years. And so you have to have that chip in order to even build out that technology. Now, NVIDIA, at least right now, has one of the leading chips for AI. But as I said, you have AMD, you have Broadcom. There's many other chips that will be used in all of this technology. So that group as a whole is really leading the charge of this market. That to me is the true leader. And I don't see that peaking anytime soon. And again, I do think that tech will continue to lead, that we're in the early stages of a bubble. We'll probably go into a bubble. But so many people are talking about a bubble that you're not in a bubble when everybody talks about it. So how do you know when you're in a bubble? You're in a bubble when you hit euphoria and everybody believes the market is going to go sky high forever. And no one basically sees a peak in the market. And that's the hard part. The other hard part is if we're right and there is a bubble, or if Andrew's also right about that bubble, bubbles are what are called parabolic curves. They're very sharp, steep curves that go up. It's the one pattern I hate the most in the market, because when those patterns end, they go all the way back to the beginning. All you have to do is look at a chart of the NASDAQ from 95 to 2000. And for 17 years afterwards, the market went nowhere. It came all the way back down. And so that's the hard part. And so the question I get, Mary Ann, if we have a bubble and that bubble bursts, what happens? Do we lose all our money? Well, you lose your money if you don't take it out. So you have to sell it and you just have to deal with capital gains. But new leadership emerges, just like it did in the last cycle. So where's the new leadership? You're already seeing new leadership in the international markets. Japan just entered a new secular bull market. It just surpassed its high of 1980. Europe is starting to move into a new secular bull market. Emerging markets ex-China are moving into a new secular bull market. In fact, the world is in a secular bull market that no one's talking about. China's not yet in a secular bull market. But the world and the world markets are in a secular bull market. This is probably one of the greatest times in the history of investing that you can almost go anywhere in the world and equity markets are going up. Now, you do have currency conversion that can impact your return, meaning like the dollar went up this year. So your returns can have an additional 10% because the dollar went up 10%. But if the dollar goes down 10%, you could lose that 10%. In the exposure. But I think these are early signs that they're the new leadership in the next cycle. This is a mega cap cycle or a large cap cycle. The next cycle will have small caps. So there are places that you can go. I think we're in an inflationary environment. Hard assets do very well. Commodities do very well. Housing is a hard asset, by the way. So I think investing in housing is actually a good investment if you also agree that we're moving into an inflationary period. So I think inflation is tame right now. It's not very high, but I would say maybe in the next 10 years, we're going to be quite surprised where inflation is and where interest rates are sitting.
I just asked if you were still bullish, and I got a fantastic lesson on global equities markets and market cycles. That was great. Thank you so much.
You're welcome.
I do
see what happens when you're in the markets for 40 years.
Yeah, you learn a few things.
I couldn't do this when I was young.
Yeah, well, this is exactly why I wanted to talk to you, was to get this broader perspective. I mean, the show's called Milk Road Macro, so it's perfect. I do want to ask, though, about, so you spoke about sort of these like medium and longer term cycles and secular bull markets that you're seeing. I do think that a lot of investors are very curious about this current short-term cycle. And a lot of people are wondering, are we going to top in Q4? Is this going to go into 2026? Do you have thoughts on that? And do you have like targets that you're looking for to say like, hey, we might have topped for this short-term cycle here?
So we've been looking for 7,000 by year end. When we came into the year, our target was 7,200. And then we hit Liberation Day. And all of us strategists had to back off because if Liberation Day happened the way it did, it would have been very challenging for markets. And once I saw that the tariffs were not going to have a meaningful impact, I went to 7,000 because we did have a bear market correction. It was going to be harder to get to 7,200. I do think we can hit 7,200 in the first part of next year. I haven't done my year ahead. I'll be doing my year ahead outlook in November. We're targeting about the third week in November. And there I'll release my forecast, my true forecast for 2026. But, again, my long-term forecast remains very bullish. So even if we were to have a bear market correction of 20 or 30%, I don't think you need to liquidate assets because I do think we're going to continue to go on to record all-time highs. Also, remember, markets, this is actually very, very, very important. Markets peak in a secular way most of the time when the Fed is raising interest rates, not when they're lowering rates. And if we're truly in an easing cycle where rates are going down, this is not a topping market. This is a market that's stimulating risk assets to go higher.
That's a really helpful perspective. I think that's a great insight about watching the larger context of the market movements that you're in. And, we could have a bear market, but just like you're saying, the larger trend is still higher. So not to get too panicked about that if we do put in a top here. I want to ask you something about gold and about Bitcoin. You said that hard assets do well in this inflationary environment that we're in. Gold keeps making new highs. You had previously set a target of 4K for gold. We've already hit that, which I don't know if that's good or bad. It's a little scary, but it's also bullish. Have you raised your target on gold? Do you have a new target that you're looking for there? Or do you think it's going to cool off for a while and take a breath?
So I raised my target to 5,000. So when I came into this year in my year ahead that I did, we put a target of 4,000 and people thought I was a little nuts. And what I didn't think we were going to honestly hit 4,000 this year, but I thought that's where we were tracking. Well, here we are. So why is gold at 4,000? Everything that could be positive for gold is positive for gold. When you have geopolitical instability, gold is always considered a safe haven. We have geopolitical instability around the world. I mean, just look at France right now, trying to put a government together. If you look at inflation, we have inflation. I know the Fed doesn't want to talk about that this is an inflationary environment, but compared to where we were a couple of years ago and where we are in core PCE, there is inflation. So gold goes up during an inflationary period. Central banks are diversifying their assets, particularly China, away from the US dollar, and they're buying more gold. And it's not just China, but China is a very big buyer of gold. So, there's a lot of factors. Lowering interest rates is bullish for gold. So again, all the stars seem to be aligned for gold to go higher. Silver's going up, and silver right now is testing its record all-time high. And it will probably surpass that. Because we're in, I believe, an inflationary period, a hard asset period, commodities do well. And the pocket of commodities right now that's doing well are metals. It's not just about precious metals. You're seeing copper move. You're seeing aluminum move. There's a group of metals that are moving. We just happen to be in a cycle for metals to be in a bullish cycle. What really dominates commodities is crude oil. And we have excess supply. The war premiums coming out now that we have settlement in the Middle East and peace and hostages returned, which is absolutely wonderful and amazing. So crude oil is under pressure, but that's bullish for the consumer, by the way. That's like a tax break. And that's kind of holding down the commodity complex for now. But if we continue to move into an inflationary period over the coming years, I would expect commodities to also go up. So just generally, commodities are in a bull market, I think, or part of it is, and metals are in the bull market, and further bull market to come in the rest of the commodity space.
Gotcha. Yeah, I appreciate the insight on that. I think a lot of people have been shocked by gold, but the setup is strong and getting stronger. So I appreciate the thoughts on that. Something else that I've been seeing some more attention on is this idea of the debasement trade. JP Morgan recently published something on this, saying that gold and Bitcoin are going to benefit from that. Bitcoin has lagged a lot behind gold's price action recently, and a lot of people are speculating about whether or not it's ever going to catch up. How are you thinking about Bitcoin right now? Where do you have a target on that? And do you think it's going to continue to benefit from this inflation and the debasement trade thesis?
Yeah, as you mentioned, I was looking for Bitcoin to go to 150. We may or may not hit that this year, but I don't think I'm going to change my target. It's still in a very bullish uptrend. Even if you look at the second largest crypto, which is Ethereum, I think in time you're going to see Ethereum break out of its all-time high. The way I look at Bitcoin is a currency, and that's been validated through legislation, right? Ethereum is a technology. It's a protocol, very, very different from Bitcoin. And it's kind of interesting when I look at investors and I talk to investors, if I talk to a baby boomer, the chances of Bitcoin being in their portfolio is basically zero. And those that do have it have bought it for the future generation, not for themselves. And the ones that do own it tend to be a younger population, millennials and down. And that's because the younger generation grew up digital. And the example that I give to baby boomers is, because they can't feel it, they can't touch it. It's not like a dollar or a coin that they feel that they have it. They don't feel that there's a government backing it. So it's just this thing that's out there. And so they're afraid of it. Well, where's Wi-Fi? We know Wi-Fi's out there. I can't feel it. I can't touch it. But without Wi-Fi, I wouldn't be on with you right now. The younger generation grew up digital, 100% digital, where everything was out there. And they know it's there. They don't have to tangibly feel it or touch it. The younger generation also doesn't want to be told when they can move money. They don't want to be charged a lot. And crypto trades on the blockchain, which is faster. I hate to use the word secure because nothing is 100% secure, right? We've learned that, technology gets better and hackers get better. Technology gets better and hackers get better. But the blockchain is the most secure technology that we have for movement. And we're moving to a digital world. I always viewed Bitcoin as that example that we're moving digitally. And I normally go through my Star Wars example when it comes to technology and digital currency. So would you mind indulging me talking about Star Trek and technology?
You're very welcome to talk about anything you'd like.
Okay. I'm sure you've seen Star Trek, right? At least
Star
one
Trek
version.
and Star Wars. Yeah,
Okay.
I've seen a little, yeah.
Okay. So Kirk has a flip phone. Well, we've been through flip phones. Aurora has an earpiece. Like, how many times do you go down the street and you think a person's talking to you, but they're talking to this thing in their earpiece, right? We now have a translator on our phone that can translate languages. Well, Star Trek had that a long time ago. They had Data, the robot, right? They had virtual reality because Meta's moving into the world of virtual reality. They had the hologram, right? If you do the Jetsons had a maid that was a robot. The Jetsons had flying cars. There are flying cars now in beta testing. And if you look at some of the things that Tesla's working on, they're working on bringing a robot to your home that can do basic domestic chores. So what I've been telling clients is what used to be our fantasy growing up is now our reality. We're in that world. Now, what's the currency that's in Star Trek? Yeah, that's the tough one. Okay, there's two currencies. There's one that's called Latinum, which is a metal that's not stable that goes into gold. So now gold is a medium of exchange again. And Federation credits. Well, what's Bitcoin? Bitcoin is a credit that trades on the blockchain. So all you got to do is watch Star Wars to know where the technology is going. I mean, look, they even had drones. Drones were part of their war fighting. In Star Trek. So Star Trek has your answers.
Mary Ann, I learned a lot from you, and I didn't expect this question about Bitcoin to go in that direction. But I do love to ask a lot of our guests about Bitcoin because I do think it's a bit of a Rorschach test, and everyone sees something a little bit different in it. And I feel like I always learn something from just hearing the different ways that people think about it. And I've not heard that analogy before, so thanks for sharing that with our audience.
You're very welcome.
Yeah, absolutely. So I want to end. We're coming up on time here. We talked about a lot of different things that are concerning people in the market. You're not worried about these things. You're still bullish. And we talked about a few things you're bullish on. But where are you most focused on in your terms of your capital, your attention in Q4? I think what a lot of people would like to know is here at the end of the year, are you more focused on the Mag 7? Is it semiconductors? Is it gold? What do you think investors need to pay the most attention to? Okay.
All of the above. So you've got all of it, right? Crypto is its own little asset. Gold is its own assets. Equities are their own assets. So I think with interest rates going down, that's going to continue to put a floor on gold and precious metals in general. I do see the crypto market continuing to stay in its bullish trend. And then when I come to the equity market, I still see semis, Mag 7 doing well. The other parts that are connected to that will do well are utilities, right? We don't have the grid to supply 24/7 anything that we want to build out. So we need a lot of infrastructure in the utility space. And I never thought I would say utilities were both growth and income, but they are now both growth and income. You want part of infrastructure, which is in the industrials. We're still at war. And when you're at war, you want to own defense companies. I expect the defense companies to continue to do very well. Even if we're not physically at war, we still have to build out our replacements. And I was just watching a program with a Top Gun pilot, and he flies with a plane that flies itself. Right. So not only are we going to have driverless cars, we're going to have driverless planes. Oh, by the way, they're going to need a lot of chips, too. You have Europe. You have Germany that's committed 800 billion euros over the next 10 years to build out its defense. And that's part of the NATO agreement that President Trump made. So there's a lot of things working in the stock market. It's just that the structure of our market is so tilted towards large cap companies. And that's because we haven't gotten a lot of new supply of companies too. When I came to Wall Street, we had over 5,000 companies that traded on the New York Stock Exchange. That's down to around 3,000 plus. More and more companies are deciding to stay private or to stay within a private structure. And that's limiting the supply, although that's opening up with products and instruments where individual investors can get access now to the private markets. So when I look at the structure of the S&P, mega cap drives every single sector. It's not just technology. You know, the consumer discretionary sector is driven by Amazon and Tesla. You know, obviously you have part of the Mag 7 in tech. You have Google and Meta in com services. So it's going to stay very concentrated in my view. That does not help diversification. It doesn't help active portfolio managers, many of which have constraints in how much they can actually own of one individual company. So one of the keys to successful investing is to make sure you are diversified. So you can own the S&P. You can even own the NASDAQ 100. Instead of Mag 7, just own the NASDAQ 100. You've heard of QQQ, but if you're going to own longer term, there's QQQM. You kind of get a little bit of a better structure under QQQM. But to start maybe branching out a little bit overseas, consider international investing. And, you know, the crypto market is extremely volatile. It's not an asset class for everyone. But if you can take extreme volatility and have a longer term time horizon, you can diversify in crypto. But if I could add one thing, if we're repeating 95 to 2000 in any way, where we had the internet bubble and we lost a lot of companies, you know, they talk of like pets.com or whatever, these companies that existed that don't exist anymore. I think that's going to happen in the crypto space. There's a lot of companies in there that I'm not sure really have true products that are raising money. So if there's true speculation happening within the marketplace, I do think it's happening in the crypto space.
Mary Ann, I really appreciate the insights. I appreciate you sharing this wisdom with our audience. Where can we send people to find more of you and your work online?
So I'm on Twitter, but I really don't tweet. I'm on LinkedIn. So if you want to basically follow what we're saying, you're going to find it on LinkedIn, whether you find it under my name, Mary Ann Bartels, or my company's name, Sanctuary Wealth.
Thank you so much for being here. I really learned a lot. I hope our audience did too. There's a lot of alpha in all of that. So thank you so much for being on Milk Road Macro, and I hope we can have you back again soon.
It was a pleasure. Thank you.
Thank you so much. And thank you all for joining us. In the meantime, until next time, stay bullish, stay safe, stay educated, and we will see you all on the next episode of Milk Road Macro. Thanks for joining us. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.